When I met Jitendra a few months back, I remembered the presentation I made in 2019. And I mentioned there's something new. It took maybe, 3 years to come back and meet you again. The last presentation I made, title was Know Your Country. It was born out of a very interesting conversation I had with a fund manager, a multi-country fund manager from FIA. When I met him, obviously to pitch our products, and I was giving certain sense of India, market, economy, and he kept interrupting, saying, I know India, I know India. I've been coming here for several years, I know India. Out of that bit of irritation, I asked few questions about India, which obviously he had very different answers. And after the meeting got over, of course, I didn't get him as client, but I made my point very clear. After the meeting got over, when we came out, my colleague who was with me, he told, boss, of these things, I myself didn't have the answer. Forget about the foreigner who came to India. We're all living here, we ourselves don't know. That's when we thought we could do this as a session, and there are few schools, colleges where we presented, some industry forums we presented. Because many times, I think it was Mark Twain who said, most of the troubles we get in our life do not come from things we do not know. They come from things we think we know, but we don't. If you say, I don't understand technology, so I don't invest in technology, that's fine. But you say you understand technology and you don't, then you invest, then you are in trouble. If you say, I don't understand Indian markets and I do not invest, you are not in trouble. But you think you understand Indian markets and you don't, then you are in trouble. So this session, talking about India, Indian economy and its resilience, there are hundreds of things to cover. And fund managers like us, we are only next to politicians when it comes to talking. Once you give the mic, hard to take it back. They'll go on and on and on. At the end of the talk, you will be more confused than what you were before it. So I'm not going to digress too much into too many topics. My first point and the last point is going to be only one, which we will cover. Before that, there are few do's, don'ts. Obviously, keep your mobile silent is important one. But there are certain do's, don'ts for this session also. So the topic is India's economic resilience. But please don't confuse with that with Indian market resilience. Economy is different, stock markets are different. But quite often, you will hear fund managers, market pundits, experts, when they need to speak about market directions, they begin their conversation with economy, sometimes global economy, and then Indian economy, macros, interest rates, inflations. As if many of these play a very important role in how markets are likely to move tomorrow, next week, next month, or even for that matter next year. Go back and do an exercise. Take year-wise GDP growth of India in x-axis, last 20 years, and put the year-wise Sensex growth in y-axis, last 20 years, and try to see a correlation. You won't find any. You won't find any. For example, March 20, we had COVID, 23rd March lockdown, April, May, June, whole India was shut. Our economy shrunk 25%, 23%, first quarter. For whole year, our GDP was down 8.5%. Next financial year, the GDP went up 7.5%. Net March 22, our economy was more or less where it was in March 20. But Sensex and Nifty went up 70-80%. Some of you who are a little old, I think the average age here looks like 30s. Some of you little old may remember 1st January 2008 to 15th July 2013, over 5 years, 7 months, 15 days. Sensex and Nifty were more or less at the same levels. But the economy of India more than doubled. So it's perfectly possible in India, economy to double and markets to remain same. Our economy to remain same and markets to double. Because what constitutes market and what constitutes economy are very different fundamentally in India. When people describe markets, they look at it from their perspective. Sensex, Nifty, mid-cap, some index. How many of us realize that Sensex and Nifty almost 40% are financials? They're not even 7% of our economy. Financials is a very small part of our GDP. IT is a very small part of our GDP. But they're all dominant part of index. If you take real estate and construction industry, that's 18% of India's economy. It's not even 2-3% of India's stock market capitalization. So when you had COVID, in April, May, June, real estate activities, zero. And then it took almost a couple of years to come back to normalcy. Economy suffered, markets didn't. Because financial services were not disrupted, IT actually thrived, so market thrived. But between January 2008 to July 2013, we had global financial crisis. So banks had to shrink the books. Indian IT companies were serving US banks, so they had to undergo slowdown. But those 5 years, real estate tripled in India. Construction activity quadrupled. So economy thrived. So depending on what is likely to move economy in the next 3-4 years, we need to decide whether markets are going to reflect it or not. In India, you can be perfectly bearish in economy and still overweight in markets, and vice versa. My greatest fear actually in the next 3 to 5 years is country will do exceptionally well. Economy will be very vibrant. Equity holders may not. Because what they are investing, what markets dominantly present, is not participating in it. And that's, I'm not predicting future, I'm talking about recent developments, which we will see in the slides view. So clear don'ts. Please don't confuse economic resilience with market resilience. Both are very different. And don't confuse our economy with global, because that's also a fashion nowadays. There are some people who say if US gets a cold, whole world sneezes. Certain perceptions we create based on certain data points. Data change, but we don't change perceptions. That's where the problem is. And these perceptions were not wrong actually. They were right in 2007-8. But data have changed. But we still carry the same perceptions. The problem is with us, not with the perception. The third point, which we should never do, is to take this on per capita basis. I'm sure how many research reports you would have read in India about per capita income is like this, per capita consumption is like this, everything looks low. The averaging we do in market all the time. Index is a weighted average. CAGR is weighted average. Portfolio performance weighted average. We are about, say, 60, 65 people in this room. If you need to calculate average net worth, I'm just making a wild guess, I could be wrong. Maybe about, say, 10 crores, 20 crores. And if suddenly Mukesh Bhai comes and sits in this empty chair, and then you calculate the average net worth, that will make each one of us look like billionaires. That's wrong. Sometimes averages are very, very misleading. So anything you do on per capita by doing a simple average will be misleading. Fourth, that we should never do. That's a strength for people like you because you might not have seen the past cycles. But that's a curse for people like us who have seen multiple cycles. Some of our mind tends to take lessons learned in the previous cycles and try to make some inference, which is nothing wrong. History repeats, but in different rhymes. But when the country undergoes a fundamental transition, some of the past cycles are not relevant. The inferences you make based on past cycles could sometimes be very misleading. And you could see that in several sectors. Real estate is dominant sector of India, Indian economy. And past cycle was very different. 90 cycle was very, very different. And what we are now seeing, unlikely to see next few years, is going to be very different. Winners are different. What drives the asset prices are different. And who is going to benefit the most is going to be very different. And we tend to overgeneralize it. That's clear, don't. The fifth is, we have a tendency to narrow frame our inferences based on one or two economic variables, which most Western countries use often. The classic variable where there is a huge gap that we find is the unemployment rate people use. Right? When US says our unemployment rate is 20-year low, it's only 3%. Most people I ask, is if 3% is US unemployment rate, does that mean 97% of American adults are employed? People think for a while and say yes. There is something called employment rate, which is about 71%. So 71% of American adults are employed, 3% are unemployed. So what about the rest? They are not counted in employment, they are not also counted in unemployment rate. So labor force participation rate comes into play. But that has a demographic angle also, which is playing out in India. We don't notice it. So the same term could bring different meaning, 180-degree different meaning in India than many Western countries. So in some context, the unemployment rate rising doesn't mean more people are unemployed in India. It could mean something else. It could mean more people seeking employment also. So these are all clear don'ts. Only do is go back to data. Perceptions are fine, but they don't help. They make stereotype inferences. So what I will begin with is what is important to Indian economy. When we talk about is India's economy resilient, where is this resilience coming from? If we need to understand, first we need to understand what constitutes Indian economy. That's one fundamental area where we take longer time to bring clarity. For example, forget about manufacturing, services, agriculture, kind of broad classifications. Look at Indian economy in terms of domestic, foreign. The total exports of India, Indian economy, exports component, what is sensitive to what's happening globally, IT, pharma, engineering, chemicals, textile, services, all, is about 17% of our GDP. But close to 61% of our economic growth, GDP, is domestic private consumption. Don't ask what is in between. It's other type of consumption, non-private, government, defense. But the 17% item, we have product-wise information, country-wise data, company-wise data, year-wise data. 62% domestic consumption. Who consumes what? It's very hard to. We have less information. Worse, we have wrong information sometimes. Week before last week, I was in Surat. And from Surat, I took a flight, went to Chandigarh. And both places, I was doing client presentations, and I was asking about consumption pattern, about eating habits, drinking habits, those kind of stuff. And Gujarat and Punjab has interesting mix in terms of eating habits. If you ask people which state has high number of vegetarians, and if you give choices, that Gujarat, Tamil Nadu, Punjab, Kashmir, invariably people choose Gujarat. Maybe because I asked that question and I look like a Brahmin from Chennai, some people may give credit to Tamil Nadu. But in reality, it is Punjab. right? Punjab has more vegetarians. Almost 68% of the population there are vegetarians. Only 62% of the population in Gujarat are vegetarians. Actually, Jammu and Kashmir has more vegetarians than Tamil Nadu. Only 4% of Tamil population are vegetarians. Only 4. Actually, we are better. The neighbor Telangana has only 2% vegetarians. Okay. So let's quickly run through about 10 questions, which this morning my colleague had compiled. We have like this about hundreds of questions. We compiled each of them in a very playful manner, in a deck of playing cards. If some of you are interested, please share your details with the CFA Society Delhi. We'll give as copy. It's a deck of playing cards, it's actual playing cards, deck of 52 cards. Each card will have something about India that we may not know, or we may know wrongly. Because that's the easiest way to communicate to the next generation, right? They seem to have far superior and better information about Western civilization and much less about our own country. Sad. So this year, New Year, instead of sending a New Year card, we sent this card to all our clients and saying that, how much of this you already know. So what we'll do is we'll take less than 15 minutes. It's not to test your knowledge, but this is relevant to discussing India's economic resilience. And each question has few choices. Don't influence the other crowd with your answers. Keep the answers yourself. Idea again is not to test your knowledge, but to see what is your mind is stored internally. So that the first choice that comes up for each of these questions sometimes could be misleading. So when describe middle class in India, there are 13 questions, 3 questions I already have used in this forum. My colleague pointed out saying that 2019 you used the same slides. For 3 years, you should do something different. But these 3 slides are very important, so I take the liberty of showing this again. If you put Indian households in a scale of 1 to 100, where 1 is a farmer in Bihar with 80 rupees daily income, and 100 is Mukesh Ambani with richest household. If you define middle class as 8,000 rupees per month per person, that's about 24,000 rupees if you are a family of 3, or 30,000 rupees if you are a family of 4. That's about 3 lakhs per annum. 3 lakhs to say 12 lakhs per annum. So 25,000 rupees to 1 lakh is lower middle class, middle class, upper middle. Where is the middle class of India? Is it in middle of India or broader India? Which of the following is the largest industry in India? Which of the following we consume the most? Is it rice, alcohol, jewelry, wheat? Keep the answer yourself and we will certainly revisit. Which is the largest business in India? Electronics and technology you may confuse. Electronics is the phones, television sets, hardwares, laptops, textile. Technology is more IT services, which is the largest business in India. Recently, when Air India ordered for flights, more aircrafts, one of the data points that came is domestic flight travel has grown a lot. More than half of the domestic travel is done by what percentage of Indians? How many Indians have passports?
Will you answer?
How many Indians have passports? Okay. How many Indians have credit cards? How many Indians have demat accounts? It's a simple question, but let me elaborate. We have about 177 billionaires in India as of last January. About 5 years back, January 2018, if you take, we had less than 100 billionaires. India has produced more than 70 billionaires just in the last 5 years. As a country today, we have more billionaires than any other country other than US and China. We are third highest in terms of countries with billionaires. These 70 plus billionaires that India has produced in the last 5 years, which industry most of these billionaires come from? We all know they are very young. Most of these 70 billionaires that India has produced last 5 years is about 10 to 12 years younger than the average billionaire's age before 2018. The age of billionaires is falling rapidly in India. So we talk so much about global economy. What is India's share of the global trade? We discussed global trade is 17% of India's share. But what is India's share as percentage of global trade? This may be of interest to students or people pursuing profession. What is the average salary of ICICI Bank? And the average salary of State Bank? Ratio. If you have numbers, it will be fantastic. But do you think both are same? Or do you think ICICI is more, then choose D? If you think State Bank is more by double, then choose B. And many of you would have been children aged below 15 in 2001. As you know, every 10 years India does census from 1951 onwards. 2021 census we could not do. Hopefully we'll do it soon. 2001 census is the first time our population crossed 100 crores. And that time we had almost about 39 crore children. How many children are there in India today? We all know GST collections are rising month on month, every year. The pace has gained momentum this year even more. How much you think is the direct tax collections growth? GST is more indirect tax collection.
Last year?
We can take even this year, numbers are not very different. What percentage of women are in workforce? We all know 45% of India are actually Indian adults are employed. So it's about 13 questions. 3 were something which I addressed in the same forum in the past. So 10 are new. We'll quickly run through the answers and then I will share why some of them are very important for us to understand. So middle class of India is middle of India. It's not in middle of India's population. If you take before COVID, all the households in a scale of 1 to 100, where 1 is a farmer in Bihar with 80 rupees daily income and 100 is the richest household. Middle class of India was between 78 to 94. That's it. 18% of India was middle class. 6% of India was rich and wealthy. 77% of India was below lower middle class. Post-COVID, inequality has grown. Richest 20 obviously has grown a lot. Bottom 20 has declined. But the real growth in India happened somewhere in between, which is what we are ignoring to notice. We use many Western terms. Income inequality is used more on T10, B50, but the India's growth is happening somewhere else, which we are not noticing. For example, the same if you put now, every year there are at least about 2 million, 3 million households coming category to category, moving up. The answer to this question would have been different depending on which year this question was asked. And all the four had right answers sometime in the last 20 years. In late 90s, Indian rice industry was the largest. 2001, 2, 3, Indian wheat industry was the largest. 2003, 4 to 2019, 20, Indian jewelry industry was the largest. Last 3-4 years, Indian liquor industry has become larger than Indian jewelry industry. But where the growth is happening the most? Indian liquor industry, alcohol. We are about 22 crore Indians in South, across Tamil Nadu, Kerala, Karnataka, Andhra, Telangana. That's about 15% of Indians who live in South. Can you believe they consume more liquor than whole of rest of India? 85% of India, including West Gujarat, West Bombay, Goa, to Central, to North, to East, still less than before. When in one forum, one guy said, we consume more single malt whiskies than whole of USA. The local ambassador, this comment was made in a Republic Day celebration. The local ambassador apparently asked, oh, Indians consume that much? He said, no, he said, I meant only South Indians. So the industry growth rates are very different in different phases of our economy. People find it hard to accept travel and tourism is a larger industry than technology. Last year, Indian IT industry was about $196 billion top line. Indian travel and tourism was $211 billion. But which state gets most of the tourism? Okay, which single place gets most of the foreign tourists?
Kerala.
But the right answer is nowhere here.
Rajasthan.
No.
Jammu and Kashmir.
No.
Karnataka.
No. No.
Northeast India. Jammu.
No. No. Which monument or which place? Even state hasn't come nowhere near. No. 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 It's actually Mamallapuram, Tamil Nadu. Mamallapuram gets more foreign tourists than Taj Mahal. Yeah. So, look at the gap. Tamil Nadu gets more foreign tourists than Delhi, than North. So we have a serious gap between what we think.
Isn't that like very counterintuitive?
it's very counterintuitive. The number of international flights from Chennai airport is a much lesser factor from Delhi or Bombay. So it means they're like,
International can also be.
There are hundreds of things we need to look at to judge.
it's like exponentially lower, the international flight connectivity, which makes it a little harder to guess that.
Yeah. But which airport handles the most of foreign tourists?
International.
International. Foreign tourists.
Delhi.
Foreign tourists. Yeah.
That's a hard question.
Ma-
Bengaluru.
Maharashtra and Tamil Nadu same. And they are in the top. Maharashtra and Tamil Nadu gets more foreign tourist landing. Foreign tourists, not professionals, not business guys.
Including NRIs also.
Yeah. Foreign tourists whose objective of visiting India is tourism.
Okay.
Delhi is the largest airport. But Bombay gets more foreign tourists landing in Bombay airport. Chennai gets more foreign tourists. This is gateway to south.
Sir, but recently we heard about.
We'll address on the Q&A side. Yeah, we'll quickly address. Even though domestic travel in flights has grown, half of the domestic travel is 1% of Indians. 29 lakh households make up 46% of total domestic travel. Five percent of Indians have passports. 5% of Indians have passports. 5% of Indians have credit cards. 5% of Indians have demat accounts. Number of demat accounts may be 10.5 crores, but we have only 5.72 crore distinctly different demat account holders. Last month, when finance ministers submitted budget, there was a meme joke circulating that 5% of Indians file income tax return. The other 95% of Indians are upset with the tax changes. Factually, it's correct that 5% of Indians file income tax return. But the inference we make is very wrong. For example, I am the only income tax return filer at my home. My home has 4 people. None of them file taxes because none of them have taxable income to disclose. Does that mean 25% of my household is paying taxes? So 5.96 crore income tax returns doesn't mean 5% of India. Out of that, I think approximately about 30 to 40 lakh income tax returns had shared addresses. Father and son, husband and wife, father and daughter. We have more than 5.6 crore distinctly different tax paying with distinctly different addresses. So out of 29 crore households, 5.6 crore households had at least one tax paying member. This is how we should interpret. That's about 20% of Indian households pay income tax. So you should not say 5% of Indians have credit cards. You can say 20% of Indian households had one member with a credit card. Why 20% of Indians? Any economically sensitive number you take, you will come around 5% of India. That's not 5% of India. Our average family size is 4.6. So it's about 20% of Indian households have credit cards, passports, demat accounts, and file taxes. The impression that only 5% of Indians pay tax may look like India's tax collection is low. Actually, no. 2015 itself, it became 10% of our GDP. Last 1 or 2 years, some of the exemptions, confusions, GDP growth, tax growth took some time to catch up, and it's beginning to catch up, and we are back to almost about 10.5%. But when people compare this with Western world, they don't realize this is only in central government tax. The 10.5% of GDP as tax collection is only central government tax. But a large portion of our tax collection also happens in state. To give a apple to apple comparison, if you take say federal tax collection, till 2 years back was about 16-17%. During Trump time it came down to even 15. So if you take 17% as the average for the last 5 years, and if you take 10.5% as the average for India for last 5 years, we are about 60-70% as efficient as US in tax collection. We are not as inefficient in tax collection as it is made out to be. It's not that only 5% of Indians pay taxes, 20% of Indian families pay taxes, because 84% of the wealth in India is with the richest 20% of India. Right? But where is the wealth creation the most? Many of us think more billionaires come from IT, startup, technology. That's what we read in newspaper. That's not where billionaires come from. They do not come from infrastructure, real estate, construction. They actually came from chemicals. Right? India has more leadership, globally leaders companies in chemical industry than IT. But how many chemical companies in Sensex and Nifty? So index did not reflect. For example, last 5 years, how much all the companies in Sensex net profits have grown. Forget about how much their share prices have grown. But by the way, both are same. But how much net profits of all these bluest of blue chip companies have grown last 5 years? About 11% per annum. How much they have grown last 10 years? 11% per annum. Is that the rate most businesses in India has grown? No. There are several businesses that have had high growth rates, but they are not in Sensex and Nifty. And that's why in the beginning I said I have a fear that the next few years India could grow a lot and Nifty may not capture it, because Nifty is in few businesses which are not participating in that growth. And 2/3 of India's stock market value is in those 50 Nifty companies. Right? When everyone finally agrees ETF is the best way to do it, then you will find different sectors moving and ETF just tracking 10-11% growth. Our share of global trade, say 20 years back, was about 1.8%. 3 is the nearest rounding number. The real answer is about 2.5. We haven't grown last 20 years in global trade. We didn't benefit from globalization. Maybe in few glamorous businesses like IT and pharma, our share of global trade has gone up. But India as a whole, it went up from 1.8% 20 years back to about 2.5% now. As much as many Southeast Asian countries, Chinese economy, they benefited from getting into WTO and global trade. And they are likely to be impacted as deglobalization happens. Not as much as them we will get impacted. This is very relevant to understand the resilience of Indian economy. In what way? So if you take the ICICI Bank, the average, I'm just going by balance sheet numbers, right? It's about less than 8 lakhs per annum, 7,60,000. Why I took these two banks is, according to stock market, both are comparable names. Both have similar market caps. State Bank has 2,47,000 employees. ICICI Bank has 1,04,000 employees. And many people felt that ICICI Bank average should be higher. than State Bank. But on the other hand, both were same about 12, 13 years back. But over the last 8, 9 years, ICICI Bank had 23% churn, annual churn in employee. And State Bank had less than 1. And women as percentage of total workforce in ICICI Bank, that used to be 10, 12% 10 years back, is today 32. So there are 3 data points I'm sharing. In the last 10, 15 years, ICICI Bank's salary, State Bank salary, which used to be more or less same, has now become 1:3. Data 1. Data 2, last 10 years, ICICI Bank had high employee churn. State Bank did not. Data number 3, women as percentage of total workforce in ICICI is tripled in the last 10 years and doubled the industry average. So if you link these 3, you will make a picture. All the 3 are linkable. And we have less children in India than what we had 20 years back. When people say our population has grown, it hasn't grown because more children are born. It has grown because less people die. Our life expectancy rate, people find it hard to believe, even in 90s, our life expectancy rate was about 52, 53. When we got independence, it was hardly 31. That's life expectancy rate of India, 1947. In 1950s, it was about 53. We made a tremendous progress in healthcare in the last 20 years. But child per women has been falling. The average family size in India in 1947 used to be 6+. Today it's only 4.5 in India average, thanks to 3.3% average family size in South. The child per women in South is much lower than 1.5. 2 is the replacement rate, and we are below replacement rate last 15 years. Okay. So why it is important is, when people calculate the employment number and you look at the employable age, working age population as percentage of total population, that's growing much faster than the rate at which the employment is growing. So when you say high unemployment, that doesn't mean less people are employed today. More people are employed today than, say, last year or 5 years back. But more people are employable today than, the denominator is growing significantly faster, which is fantastic news for us. That's not bad news. Unemployment rate growing along with the employment rate falling is a bad news. Employment rate going up and unemployment rate growing is a reflection of more the denominator than anything else. Even our direct tax collection is 30-35%. Yesterday in one forum I was asking a question, how much is direct tax collection of India in 1991? Today it's about 14 lakh crores, 15 lakh crores. When we began liberalization, what was our direct tax collection? Just guess. 1 lakh crores. It's about 11,000 crores gross, 9,700 crores net. That's it. The whole country's total direct tax collection has grown 125 times. So we used to be a 2% tax to GDP country. 2% tax to GDP country. We now come to about 10.5% tax to GDP, and GDP is rising, tax collection is rising several times. But if corporate tax collection is growing 34%, should we not be asking a question, if we are a corporate and we are paying 34% higher tax, should it be either because of tax rate going up, which it hasn't, or taxable income growing up, which also we don't see. Which means what? We are not seeing where it's growing. The compliance standards have improved. Reporting of income is improved. Or either the unorganized player has become organized player, or customers are moving from unorganized players to organized players. Fact is, it is getting organized, and it's a beginning of a long-term trend. Initially, when these rates were going up, people are saying it's pent-up demand, it's carryover from COVID. That's one habit we have, which as a rational person we should never have. Nothing to do with COVID. If something happens, we try to narrow frame our perspective based on something that happened around the same time. If Demat accounts started growing from 2020, media was writing that COVID, people are stuck at home, so they are opening Demat accounts, dabbling in stocks. Once normalcy comes back, activity level will come down because people will go back to office. It didn't happen that way. Actually, normalcy came back and number of Demat accounts went through the roof. Because Demat account opening and COVID had no correlation. But we are trying to make some correlation because it happened around the same time. So tax collection growth is a reflection of unorganized to organized. And it did not happen when GST got launched in 17-18, first year, second year. But it certainly put the seeds strong. And it began to happen. And according to us, it's the beginning of a significantly long-term trend. And it's not just a 1 year aberration, 2 year aberration. About 15, some numbers are 17%. Is the women employment rate in India. Global average is more than 50. US is close to 67. But in India, even though some of our numbers are little distorted, because till 2014, our definition of women employment in rural India was slightly very different. So if someone enrolls in MNREGA and they work 2 days in a week, anyone who works for 2 days in a week is counted as employed. And that's precisely the reason they had this as a 100 days employment, just to fit into that global definition. So that if someone is employed at least 2 days in a week, they are counted as employed people. But after the direct benefit transfer came in, a lot of these fudge numbers removed, the rural unemployment rate fell dramatically from something like 25-30 to below 15-16. But the women employment rate in urban markets has been rising, is according to me the single most important progress that has had profound impact in many businesses, but we don't actually notice that. While women is only 15, 17, 18% of the workforce now, last year we had 59 lakh graduates who came out of colleges. This year it is going to cross, first time in India, it is going to cross 60 lakh graduates a year. And first time this year, we will also have 1 lakh doctors, medical graduates this year, 1 lakh. How many doctors are there in India today from Indian independence till date? Totally, cumulatively, how many doctors are alive and practicing in India?
10 lakhs?
Yeah, 9 lakhs. We have totally 10.5 lakh doctors, and active participation is about 85%. 85% of the doctors practice. Rest are either retired, very old, or have become politicians. 85% are practicing. So in a country with just 9 lakh practicing doctors, you have 1 lakh doctors coming, join from college. So it's going to have a dramatic impact on doctor availability, right? And this 60 plus lakh graduates, last year 59, 14 lakh postgraduates, 44 lakh undergraduates, 63,000 doctors who came out of colleges last year. more than half were women. This year, 62 lakh graduates. More than half, 53% of the graduates coming out of colleges are women. The 17% workforce has more than half the demand in the job market. The 64% male employment rate has less than half the demand. So this is a sign of what we are likely to see in the 3 to 4 years from now. So this is thanks to an work an NGO did. I don't know how many of you heard about this professor from IIM Ahmedabad, Professor Rama Bijapurkar. She has done several books. In fact, the book she wrote 20 years back, still considered, there's no other way to explain Indian consumer industry. She aptly titled that, the title was, "We Are Like That Only." It's about Indian consumer market, right? And she sits in several boards, Nestle, Sun Pharma, Axis Bank, Prudential ICC, some time back. She has been doing this Indian consumer experience survey since 2014. Initially, Tata Trust funded the project very generously. It's a non-profit and it's a very grand scale. It's not one product in one geography. It's multiple. To give a sense, it gives you a certain sense of how many people in Bombay go to office in auto rickshaw. That granular study. And it gives certain perspectives, also very interesting inferences. This website, ICE 360, if you visit, you will find enormous amount of data. Sad is, we don't read many of them. For example, when budget comes, we all read budget provisions, but no one reads the economic survey of India, which comes a day before. You know how much of man hours that go into preparing that? You know how much of granular details we give? I remember 6 years back when I read the economic survey of India, that was 2017. There is one annexure. That annexure is brilliant. It was done, I would say, world standard. I've read quite a few reports globally, but this one done in 2017, the title was The Thalinomics. It's an economics of a thali in India, right? What an average age 30 years old male eats in which state, how much is protein content and how intake happens, how a healthy woman of 30 years old eats where, how much is the cooking cost as percentage of the total meal making cost, why it differs from state to state. Some of those inferences are extremely useful in stock picking than most of the analyst reports that we read. Right? So this is a good place to have a great understanding of Indian consumer industry, because that's 62% of Indian economy. If you don't get clarity on 60% element in a GDP, what is going to give you any kind of clarity when we talk about Indian economy or its resilience? That Indian domestic private consumption, which is bringing the resilience, where is it coming from? Who is consuming what? Are we growing because our consumption is growing? That's the first and final point I am trying to make. When you see crowd in an airport, is it because Indians are flying more? When you see tax collection growing, is it because Indians are paying more taxes? When you see number of demat accounts opened, total number of demat accounts in 2010 was 2 crores, 2018 3 crores, 2020 4 crores, 2022 10.5 crores. Is it because people like you and me who have been having demat accounts last 20 years open more demat accounts last 2 years, or people who never had demat accounts last 20 years open in the last 2 years? It's the latter, right? If mutual funds have collected more money from investors in the last 4 years than what they collected from 1993 till 2017, Is it because you and me invested more money last 4 years in mutual funds, or more investors who never invested in the past have invested now? If SIP collections are hitting new high each month in spite of no return for a year or two, is it because Indians are investing more in SIPs or more Indians investing in SIPs? Where is this more coming from? One mistake many people do, which we also have been doing for a while and corrected it and greatly benefited from, is a simple insight, but it is very powerful. It changed the way my perspective of the economy and the progress changed. It was very validating evidence was last couple of weeks back when RBI announced this data, that last year households borrowing credit has become larger than corporate borrowing last year. First time in history of India, cumulative borrowing by households in size became larger than total borrowing of all corporates. First time in India. Economic Times headline, as usual, was Indian households borrowed more. That's how our mind thinks when household borrowing went up. But it was a wrong interpretation, because the average borrowing by household declined last year. It's more Indian households borrowed. Indian households didn't borrow more. But Indian households borrowing more and more households borrowing have completely two different meanings. Right? Indians opening more demat accounts and more Indians opening demat accounts have completely different meaning. Why? Because let's say richest 20% of India, which is most consuming part, because as I mentioned, if you take in the scale of 1 to 100, the 99 to 100, richest 1% of India owns 40% of the wealth in India. Okay? That's not India phenomenon, it's global phenomenon. But what is India centric is the 90 to 99 owns 23% of the wealth. The 80 to 90 owns 21% of the wealth. 21 plus 23 plus 40. 84% of the wealth in India is the richest 20, which is that 5% of Indians we talked about. Passports, credit cards, demat accounts. That's the richest 20%. Their wealth growing more, their income rising doesn't mean more consumption. Their income rising could mean more savings. Right? And the same professor in the same study has proven that per unit increase in income of the richest 20 and the next 20, how the consumption grows much more in the next 20. Let's say you are the richest 20 and then a second richest 20, and your income is 50 lakhs per annum. My income is 5 lakhs per annum. And both our income grows 10% next year. Whose consumption share will be higher? 5 lakh guy whose income went to 5.5 lakhs will consume more than a 50 lakhs guy growing to 55 lakhs. You may save more. I'm going to consume more. This much was clear as we were reading. Where our excitement came is, if the second richest 20 is fastest growing, if you convert this into this number, which again is thanks to her work, I'm just using liberally with full credit to her organization. The blue line is the richest 20% of India. Okay. The yellow is the second richest 20. Grey is third richest, black is fourth richest, red is the poorest 20% of India. The blue has been fastest growing income group of India for many years. They are the most income is with them and they are the fastest growing. If you see in 2005, 6, 7, 8, there is no political reason why we choose 2004 onwards, but it was there that way, so I used that way. For many years, Yellow line was growing like rest of India. Don't you see from 2017-18, the yellow line, which was growing like rest of India, is breaking out from the rest of India? This yellow line, which is the second richest 20, their household income is rising faster, which is counterintuitive. In our mind, we are thinking India has become highly unequal society. But the degree of inequality is using the top 10 and bottom 50. Thomas Piketty, who does study people governments take seriously, he uses that number, which is why I gave the number on ICICI Bank and State Bank. State Bank average is very high, ICICI is very low, in a scale of 1:2, 1:3 kind of number. But if you take T10 divided by B50, what is that? For example, you want to calculate in your company has 100 people. Take the top 10 people, their total CTC average, divided by the bottom half, their average, T10 divided by B50. If it is 5, it's considered fair. Degree of inequality starts from 5. If you take, say, Australia, it's about 7, 8 as a country. Scandinavian countries will be around 6, 7. US is 18. India is 23. Russia could be 50 plus. Saudi Arabia is even worse. Within India, if you take State Bank, it's 5 to 6. The T10, chairman, managing director, CGMs, they all will be getting 40 lakhs to 50 lakhs salary. The bottom half of the people in State Bank will be getting 8, 9 lakhs salary. Whereas in ICICI Bank, the bottom half of the employees in the bank is getting only 5, 5.5 lakhs, maybe even less. But the top 10% could be more than 50 lakhs, 1 crore. Their ratio could be 20, 30 times. State Bank could be only 5, 6 times. But the T10 B50 for whole of India is 23 times. But that's growing, which is fact. So income inequality is growing, T10 divided by B50. But the real growth in India is coming from actually 60 to 80. They are not part of T10, they are not part of B50. So this income growth in the second category has more impact on consumption than equivalent growth happening in the richest 20. Got it? So where is this income growth in the second 20 coming from? Is it because salaries are rising, or is it because business income is rising in MSME or middle income? No. There are 100 reasons, but the most important reason is women participation in workforce, the highest in the yellow category. That's a change which we are not noticing. And it's already happening in certain software businesses. Last time when I was in Delhi, I met the executive who actually runs the airport. And one of the statistical point which I was giving, that India has more women pilots as percentage of total pilots than, say, US. And he could easily relate that because he has to create certain common facilities for women crew in certain manner. And which he said, when we initially put it, we didn't think in this manner, but that degree has changed. What used to be 5-6% women has become 20% women in among pilots. And we don't notice that in, for example, if you take the entire Indian IT industry, what used to be 12-13% has already become 35-40%. Right? While in the software businesses, it has happened in a very grand scale. The beginning of that happening across several sectors is likely to have profound impact on the consumption patterns across sectors. We are beginning to see that in few sectors. For example, same example which we used if we take now. So let's say my household has 4 people and they earn 5 lakh rupees per annum. Her household has same 4 people and earns 5 lakhs per annum. Both our household are 4 people with 5 lakh rupees per annum, growing, say, next year to 10 lakhs per annum. In my case, because I got increment. In her case, because she started working in addition to her spouse. So both our household of 4 people, both our household income we moved from 5 lakhs to 10 lakhs. In my case, because my salary went up. In her case, because she started working. Which household will have more consumption share of income? Her household. Which household will have more confidence to borrow and consume? Her household. That's precisely what's happening. While income is growing in India, it's not growing across all categories. It's growing in second category. And it's growing because along with more women participation workforce, which is why you find consumption patterns very different in very different categories. Why oral care has grown only 1.5% per annum last 5 years. Soaps have grown only 4% per annum last 5 years. But footwear industry has more than doubled. So if you look at the consumption product wise, there is some reason why air conditioner sales last year crossed 1 crore units, which is a record high. And some other side you see slowdown or certain types of lack of growth in many other consumption products. The easiest way to understand the consumption trends, very, very different in different businesses, is to understand where the growth is coming from and the role of women in the consumption bracket and the category of households where the consumption growth is highest. That's my view. Thank you.
Sir, you mentioned about Delhi airport being the biggest one. Delhi airport being the largest, being one of the largest in the country. But most of the traffic being handled by Madras and Mumbai airport. But recently we saw a huge spike in terms of arrivals on most of the terminals in Delhi airport. So how would that explain that skewness of the curve? How would that explain?
So your question is, most of the foreign tourist arrivals are in Tamil Nadu and Mumbai.
But we saw a huge spike at Delhi airport also.
See, Delhi airport activity, not just foreign tourist arrivals. A lot of foreign arrivals, non-tourist also. Non-tourist. So let's not confuse tourist data with traffic in Delhi.
It's just one of the subsets.
Yeah. Tourist data is different, traffic in Delhi is different. Traffic in Delhi is mostly domestic and connecting flights. Yeah. Traffic in Delhi is, Delhi has become busier than JFK. It has become busier than Heathrow. It's far busier than Singapore. Before the World Cup football, it became busier than Dubai for a month. Last March 2022, it was busier than Dubai. To become second most busiest airport in the world. And the most busiest airport, Atlanta, is not far away. They handle about 43 lakh passengers. Delhi handled 38 lakh 40,000 passengers in that month. So at this rate, we will soon reach. But how many aircrafts in India? Hardly 700, 800. That's it. US has 8,000. China has 5,400. With that, one airport in Delhi has become second most busiest because 30% of the takeoffs landings in India on the airport, Delhi. 30% of the takeoffs landings in India. So it's going to change, and it's changing a lot. It used to be 45% some years back. The tier 2, tier 3 airports are coming in, regional airports are coming in, and some of that could sort out the mess. So the traffic in Delhi airport, like last December, it took 2.5 hours to clear check-in. We didn't ask the fundamental question, how many people are there in the airport? Had we known that the number is more than JFK or Heathrow or Changi, we would have not felt that as inefficiency in airport operations. So the foreign tourist arrival, forget about foreign tourist arrival. The domestic tourism is a huge, huge industry. in size. And it's beginning to grow. And it's growing in size which will have, so there are about 3.2 crore employment in tourism related. Why some of these are very important progress is, for example, if you take IT, how many people are in the IT industry? About listed, unlisted, large, mid, small, entire Indian software industry, about 53 lakhs, 53 lakh employees. How many employees in textile industry? 4.3 crores. How many employees in tourism industry? 3.4 crores. So some of the changes in these businesses are likely to have huge impact on domestic consumption than the changes that you are going to see in just in IT industry, right? So tourism, domestic tourism is beginning to grow, and what is benefiting from that is few states, but as it becomes more widespread, you will find a lot more. Some of the investments happening in railways will also help in that way.
In this traffic of, say, domestic travelers, just my last question is, in this huge chunk of domestic travelers, there might be people who are just traveling for a day. They are the professionals, largely assuming. And rest of the people, we can assume that, okay, the person who is traveling for more than 4 days might be on a leisure trip.
Yeah.
So how we can segregate that data also?
We don't have ready data on that, but what we have ready data is the age of such travelers. Earlier, the travel used to be more pilgrimage, visiting relatives, those kind of stuff. And for example, had you been frequent visitor in, say, 5-star hotels, had you been going there each month, say 10 years back, you would have seen similar faces, similar types of faces, which is not the case today. You see much different. So it is not that the traffic has grown in this because Indians are traveling more. It's more Indians traveling. So this more Indians, where are they coming from? Tier 2, the second 20, and they are much younger. For example, 10 years back, if someone had said that there will be about 60,000 Indian households who will take EMI option to go for a holiday, I would not have believed 10 years back. But there's a reality now. Your confidence level will come because of the type of income and the women participation in such decisions at households. So I think many of that will play out in a manner which will have impact on domestic consumption. All I'm saying is the type of income growth that we are seeing in households have disproportionately more impact on consumption than what we had seen in the past. So, and the role of credit is also a big important, because the households are extremely under leveraged in India. All else being equal, if the leverage option is chosen by the Indian households on consumption, the number that we will see in the next few years is very exponential.
So other factors like age, etc., can tell the story of household consumption and the professional consumption.
Possible. Thank you. Yeah.
So in the starting, you mentioned that you're not a bit optimistic about the equities down the 5-year period or 4-year period. So from an retail investor perspective, where should the people start invest to start in? The second question is...
Yeah, we'll do one by one.
Yeah, sure.
His question is, I mentioned that equity returns may not be equivalent to the economic progress we as a country make. The reason is our market capitalization, the Indian stock markets, are extremely skewed, where hardly 30 companies in Sensex make up half of India's market capitalization. And just 50 companies in Nifty index is 2/3 of that. And the top 100 companies is 70-80% of the market's total. Which means whatever money investors are putting in market, 70% is going into those 100 names. And those 100 names are just financial services, IT. Financial services and IT is half of whichever index you take. They are not going to benefit from any of these. At least banking as an industry may benefit, but not necessarily the banks which are in the index. Because we tend to make assessments based on sectoral level as if all sectors are homogeneous. That's not. So as I mentioned, when the real growth in India's economy came through chemicals kind of business, Sensex and Nifty didn't benefit from that because there were no chemical stocks in Sensex and Nifty. When I began my career in 91, steel, cement, power, textile was 50% of the index. Had you stayed with the same name, you would have missed out on IT, pharma, engineering that grew so much in 90s and came to index in 2001. So index captured the IT, pharma, engineering post 2001, not during the growth phase. But 2001 still financial services was only about 6-7% of, less than 10% of the index. They were not 40% of the index. So financial services grew so much in early part of 2000, 2010 to become this dominant. But today if you go and invest 100 rupees in equities, out of that 40 rupees in financial services, 15 rupees in IT, 14 rupees FMCG, 11 in oil and gas, 10 in pharma, 7 in auto, 6 in metals, and then you think this India's growth is what your portfolio will reflect? May not. So two things will happen. Most of the growth there will be, I think the index composition, maybe $5 trillion is what Prime Minister thinks we will reach in 3 years. Pessimists think we could take much longer time, but eventually one day we are going to reach. But whichever point you want to take as the milestone to evaluate, say $5 trillion economy as the milestone, at that time, index composition is not going to be similar. It's going to undergo a change. Financial services has a good reason to decline in terms of weightage. Something else which has a good reason to come in, most likely domestic consumption story. I have no clue which one is going to be. But that change, if you stay with most of the current investors who stay with the index may miss out. That's one fear. Second, many people in India still think business growth means most companies in that business will grow. There are all businesses in India you can put in two categories. One is homogeneous characteristics. The other is heterogeneous characteristic. For example, banks to some extent are homogeneous. If I am ICICI Bank, you are HDFC Bank, she is Axis Bank, someone is Kotak Bank. We are all large, we compete with each other, we serve clients in several geographies, several sectors, several locations. And if interest rate goes up, it goes up for all of us. If it declines, we all of us benefit. And therefore, it is natural to expect when one bank announces growth in credit, the entire banking stocks begin to move. Same way to some extent, big IT also. You will never find TCS up 15% and Infosys minus 15% because they are large, they serve clients in several geographies, several businesses. Pharma, as long as it was serving US market, 50-60% of Indian pharma, used to move in a homogeneous manner. But if you take, say, aviation, it's not a homogeneous industry. It's extremely heterogeneous industry. Last 5 years, the industry has grown more than double, but Indigo has quadrupled and Jet went bankrupt. Right? Broking industry has grown 3 times. Number of shares traded in stock exchange has grown, but Zerodha has grown 25 times. I can show you several brokers who are down 50%. These are all heterogeneous in nature. Saying that insurance industry will go 10 times in the next 10 years and going and buying insurance stocks is foolish. It was as foolish as someone saying textile industry will grow 10 times in 1992 and going and buying textile stocks. The industry indeed went up 10 times. Textile stocks did not go. So you may find different disruptions happening in such businesses. Industry may grow, someone else will take the pie. How many of us would have expected the biggest NBFC to have the face competition from a telecom player? So I think to elaborate my initial observation that a country could grow exponentially, the consumption will drive that. We are a lot more resilient. Indian consumer is not going anywhere. It's there. We just need, our worry is not the opportunity. Opportunity we are clear in mind. Our bet is many of these consumption trends are heterogeneous in nature. How do I ensure that I don't go and buy Jet Airways instead of Indigo? How do I end up buying a Zerodha kind of stock rather than a broking company if I'm bullish in broking? So I think if that skill set we have, there's a lot to be made in this growth. But people tracking Sensex and Nifty and index stocks may still benefit, but not to the full extent. They may benefit an average. Yeah. Yes, sir.
Please take the mic. Pass.
Just to add on to his question, if let's say 100 rupees, where would you invest? Say that buy, not financials, or if not IT in particular, where would you invest? And let's say top 5 sectors you're looking for.
Last year, our fund management fee income was about 150 crores. And we took about 15 decisions. We were asking few of those decisions. So it's very unfair for me to answer that question when I have people paying hundreds of crores to know those decisions. Thank you.
But sir, I have one question. So, if we are saying that the financial market is not related to like Indian economy, 60% is the domestic consumption, then what are the options to invest in economy? Like do we have enough large corporate in that 60% Indian consumption where people can invest? Like tour travel, what are the major corporate where you can invest?
Yeah, that question has different answers depending on different investors. If that question comes from FIAs, my answer is forget it. Because there are not enough options in listed markets. But that doesn't mean your universe is listed markets. For example, the entire value chain that came in air conditioner industry growth, who benefited from? Not anyone in listed markets. Shareholders of listed companies in other markets benefited from, whether it is Samsung, LG or Daikin. Okay? So all the consumption growth that we had seen in electronics usage, except for Dixon, who else benefited? No one else. But shareholders of Apple in US benefited from. So economic growth is real. Consumption growth is real. Portion of that will be benefiting Indian entrepreneurs. A smaller portion of that will benefit Indian listed companies. And a very small portion of that will benefit the top 100 listed companies. But if last 5 years, toothpaste sales has grown 1.5%. Footwear industry is more than doubled. The largest footwear company is a small and mid cap. The largest toothpaste company is a large cap. So when you focus your attention to the top 100 names, you could benefit from the growth in toothpaste business, but you can't benefit from the growth in footwear industry. So if you're a smaller investor and you have wider choices of businesses to choose, there is a better chance for you to participate in this consumption-led growth far better than an FIA who invests 86% of their money in 50 stocks. You have a better chance. That doesn't mean you can benefit from the entire value chain. For example, if only 6% of Indian houses have branded mattresses, and mattresses as an industry is likely to grow between 20 and 25% per annum for a long time to come. And I have no hesitation in putting that number. But I don't know who is the winner. Winner could be a listed company or unlisted company. Or within unlisted company, there may be 10 other choices. So can you benefit from that growth if you invest in Sensex and Nifty? You can't. Can you benefit from that growth if you invest in large caps? You can't. Because there's no large cap mattress company. But eventually we'll find a large cap mattress company in 5 years from now. Right? So that evolution is a lot to benefit if you have wider choices. I'm not saying we have wider choices, but we have much wider choices than mutual funds, than FIIs. As investors, you and me have an advantage of size, right? We are much smaller and therefore we have wider choices of businesses to consider. But if you are a private equity investor, you have even more wider choices. But they have a certain disadvantage of scale. They need at least 20 million, 50 million decisions. You and me don't have that problem. Even if we can invest $500,000, $1 million, we are still. So our choices are even better. Yes, sir.
Sir, you talked about women's participation.
No. Can you? Others can also benefit from your question. Yeah.
So you mentioned women's participation rate in India in the workforce. So a glaring example is Zara Select City Walk Mall in Delhi. So my wife goes there and I accompany her. So average, a top is around 3,000. There are 5,000 tops also, rupees. And a lot of women are there. And there is men's and kids section also. But women accompany their husbands there. Okay. And women are paying by credit card. So it is obvious what you mentioned in whole of your presentation, that they are employed, they have cards, and they come probably recurringly because they love Zara, and also because Zara's inventory turnover is probably 15 days. They are holding sales, and so they must have studied this phenomena, because in Europe they are big. And I've seen Europe, Spain, Zara also, they are a Spanish company. But in India, they are coming up in a big way because women's participation rate is more. So that's
yeah, it's a one validation, I agree. But that is much smaller market still. That's still a 1-2% market. At best, it could become 3-4. But the real opportunity is yellow. So you will find opportunities of different categories. Our idea is to spot investment opportunities out of that. So I'm giving you a perspective from the investable universe point. Yeah. Yes, Jitendra. 1 minute. Yeah.
So you mentioned about economic survey and this IC 360 data. Which are some of the other sources of these data and statistics which are not popularly known and which we can easily, track as laymen or investors?
See, India is a very complex country. Several states, several languages, several sectors. And one of the biggest challenge in India is data. Timely, available, reliable data. Therefore, it is not one place where we can get this. Unlike Western countries, which have taken much longer time to put. So we put up our Ministry of Statistics hardly 20 years back. Before that, we never even felt a need to have a ministry for it. So I think some of this inefficiency will remain for a while. We need to be clear of what is the data we need. If you get that clarity, then it is easier to connect the dots. For example, when we wanted to have home buyers data points, because there is a feeling that the average age of home buyers are falling. But how do I get that data? I can't literally go and seek state level because it is a state level registrations, home buying. But the moment you realize that 86% of the homes in bought are home financed, okay, and 100% of home finances get refinanced in some manner or the other, and National Housing Bank is the leading, and it is 100% owned by RBI. RBI provides data points. Then it's easy to connect. Similarly, when HDFC merged with HDFC Bank, 6th March 2022, they put several slides, and one of the slides they give information about average age of the home buyer, how it was declining. Average tenor of the home loans, why it used to be 20-year loan people take, but 80% of the home loans get closed before year 8. It was shock to us. It was a shock to us that 50% of the home loans get closed before year 6. And therefore this impression people carry that Indian households are conservative, spendthrift. They take 20-year loans but they repay in 6 years to 8 years, which is wrong inference to make today, because what no one noticed is the average age of a home buyer was 42 10 years back. Last year, if you take a city like Pune, the average age is 29 years 3 months. Bangalore is not far away, it's 31. So 42-year-old of 2011 paying back home loans in 6 to 8 years versus 29-year-old of 2022 is going to be a very different animal. Because the 42-year-old of 2011, he was born in 1970s, he worked 15 years to save enough money to buy a house. He still took a 20-year loan because that's the EMI he could afford. But when he turned the age of 50, he is going to use all his resources, conserve and pay back debt. But the 29-year-old of 2022, he was born late 90s. He worked only 4 or 5 years to save enough money to buy a house. And he is not going to pay back at the age 36 to 37. He is actually taking 20% of the home loans as home improvement loans in doing up the house. So what I am only saying is, now I have given 5-6 different data. The source for all these 5-6 is very, very different. Some from the industry leaders' presentations. Usually when an IPO happens or a merger acquisition happens, the letter of offer is a good place to have. Don't go strictly by that, but it gives you a certain perspective of the scale, the industry, the customer, the vendor, supplier, management, peer group, competition, because it has to be detailed. So many years back, 10 years back, we used to run a fund called India Spin-off Fund. Did reasonably well, nothing great, but the specific opportunities that fund was pursuing, it was giving certain perspective about company which no other way you will know. Because during demerger, you have to value every asset, every liability. And those days before NCLT, we used to go to, every demerger has to go through High Court. High Court has to convene shareholders meeting, creditors meeting. And the meeting, to call for this meeting, the company has to provide information. And that has to be very, very external. So source can be from, but you need to be clear of what data you need. There is no one place where you can read 100 pages and get holistic perspective. That stage India hasn't come, and we are unlikely to come anywhere closer. But if you say that this is the business I need to check, then go to industry leaders, their customers, their vendors, their merger transactions, some spin-offs that happened. It will give you, along with that, government data, ministry data. I think some of the ministry government data points, like I mentioned about ICE 360, which in turn was referring certain Ministry of Statistics information, like RBA, they are very, very powerful, not bad actually. Yeah.
So just one, here's a request. I mean, we would love to have you again and again for these kind of presentations, but maybe if you can, you should consider writing a blog maybe once a month, once in a quarter, where you can, whatever you're coming across, for people like us who don't kind of get to those sources, and your insights would be very helpful. So please do consider that.
Surely. Thank you. Yeah.
Sir, my question is regarding behavioral finance, because we can crunch up the numbers in a spreadsheet as much as we want, but the markets are volatile. So how should one retail investor think about the behavioral aspect of it, of investing? And my second question is regarding the specialty chemicals. What's your outlook on it?
We'll take one at a time. There are several experts in this field. Jitendra himself knows the master of that, who by the way lives in Delhi. But I think, let's say you master the behavioral aspect of it. Does that mean volatility you can manage comfortably? No. You can manage it relatively better. That's it. There are certain traits of behavioral investing can be learned. Certain things cannot be learned. It cannot be taught. I manage maybe about 7,000 families. And not all are same. Many are quite unique. And we tend to think, large means more sophisticated investors. Not necessarily. We tend to think investors with long years of experience are more sophisticated. Not necessarily. Not all of them. There are certain people who have certain characteristics who can't see a minus, or when they see minus they get very uneasy, and they will react in panic at precisely wrong time, near the bottom, when they can't bear that pain any longer. Can you go and teach them behavioral investing? Trying to change them, we will go mad. So we will need to leave. But one thing we can do is, before you engage with them, or you as an investor, before you begin, if you treat equity as ownership interest in a business, rather than a piece of paper moving up and down in value, 90% of the behavioral investing benefits come through that one perspective. Right? When I buy a stock, whether I buy 1 share or 100 shares or 1% or 10% of the company, what am I buying? I am buying ownership interest in a business. Right? Every company has a lifetime. You have a lifetime, I have a lifetime. Like you and me, every company has a lifetime. There are a lot of statistics which show 6% of the companies live longer than 50 years. That doesn't mean 94% get closed. But the other 94, some of them get closed, some of them get merged, acquired, form different manner, exit certain businesses, move on. Corporate life is also evolving. But independent of this, all shareholders in a company, in the lifetime of the company, cannot earn more than company's total earnings. Cannot earn. If you go and buy a 20% growing company at 20 PE, and after you buy a company's earning keep growing 20%, you will make 20%. Same company, if she comes and buys at 40 PE, and thereafter company's earning grow 20% per annum, but I have made 100%. Instead of making 20% per annum, I have made 100% for 1 year. Which means someone who is buying from me should make much less than 20% per annum for the rest of the life of the company, if the company's earning grow 20%. But if someone comes and buys from her at 60 PE, instead of making less than 20%, she has made 50%. Which means that guy should make much less than 20% per annum if the company is. So, collectively all shareholders in that company should earn what that company earns per share in the life of the company. If you own 100% stake in that company, 100% of that company's earnings is yours. If you allow me to join you as a 10% partner in the company, 10% of that business earnings is mine. So if I buy 1 share, earnings per share is my gain. Rest all come and go. Earnings per share is shareholder returns. But share price has 2 variables, which is E multiplied by PE. Where is the behavioral investing comes? And managing the PE part. Where is the E part coming in? That's where industry knowledge, skill set, understanding of market dynamics. And there, if you are humble enough to accept, I don't have any special skill set or some insight in understanding macro trends, market trends, then you diversify. That's where diversification comes. If you know what you are investing and if you are terribly brilliant at it, you should put all the money in one idea where the earnings growth is real, which is what promoter does, which is why he is doing well. But if you are brilliant and confident and about 2-3 businesses, you should have 2-3 stocks, which is where all the money, because at the end of the day, in the life of that business, how much you are going to make is the earnings of that company, earnings of that business. So to answer your question, behavioral investing comes in more in managing the PE part. If you look at stock as ownership interest in a business, at least 80-90% of the gains you will make by being familiar and aware of behavioral investing, you will get it by just this one thing. And therefore, the first 80% improving yourself can come from recognizing equities as ownership interest in a business. The rest of the stuff, there are several experts who can help in that. Yeah.
Okay, last question.
Last question. So, when you're saying, we told about the investing, if I'm a long-term investor, what should be my time horizon for investing? Considering all the points you mentioned in the last.
My honest answer is there is no one time period. The long-term investing should be at least one full business cycle. See, every business is cycle. We only call few businesses cyclical, but the cyclicality in certain businesses are very evident, like in commodities. The cyclicality of certain businesses like auto are less evident, but they do exist. But there are several other businesses where it is clearly not evident. But cyclicality exists. So long term is a function of cycle. Certain cycles are only 2-3 years, and therefore it's more than enough if you are in that business. For example, if you have the skill set to evaluate steel cycle, if you have the skill set and you think you have but you don't have, you will lose lots of money. But if you genuinely think you have the skill set and you genuinely do have, when the cycle changes, I think if you have 2-3 years, that's more than enough. Because cycle change happens in 2-3 years. But which 2-3 years, Janta doesn't know. You know. And therefore you are choosing. But if you are betting on a consumption cycle that we are betting on, I think 6 to 7 years is fair enough to be considered as long term. I'm not predicting 10-20 year trend, because I'm investing on a trend which has already begun to take shape. When I met India's the best known investor, most successful investor, whose track record is better than any fund manager, including Unifi. So we asked this question. My colleague asked. I took my colleague to meet him, and he met first time, super excited. So he said, "Sir, we are all aspiring fund managers from Chennai. If there is one lesson with which I can go back, can I ask you a question? How long is long term?" I thought he will not answer the question. His question was instant, rocket. He said 15 years. He is little old, he is 60 plus. So his 15 years is a reflection of the business cycles that he has seen. Right? If you look at most of the businesses that he had seen, it's 15 years. For example, Unifi is 20-year-old company. We started with book value of, let's say, 10 rupees. How much book value first 15 years that we made is what we are making every year now. So had you evaluated this business in the first 3 years, 4 years, 5 years, it would not have given any sign of what it actually indeed was at 15 years. But 15 years doesn't mean you should be a 15-year investor. You would have invested not in the first day, no? That's for the private equity or promoter. Some of us invest in the early stage. Some of us invest. Early stage doesn't mean early stage in private equity sense. Early stage of the growth in the listed markets. I think the right answer is somewhere between 2 to 3 years to 7 to 10 years is the long term. That depends on the cycle that you want to participate. There are certain people who have a habit of going to the party 11 o'clock at night. There are certain people who have the habit of going just in time at 8, 9 o'clock. There are certain guys who will go to the party before party starts in 6 o'clock. You should ensure that you don't get into the party after 12:30 because others will vomit on us. So as long as you don't try to get last minute to the party, I think you should be okay.